Over the past year, inflation in Russia has had some surprising twists. In May 2023, despite tough international sanctions that made imported goods much pricier, Russia's inflation was incredibly low at 2.5%. This raised some eyebrows about whether this number was really accurate. From May to November 2023, inflation shot up, reaching 7.5% in November, the highest since February 2023. Then it seemed to level out, staying between 7.5% and 8% for the next 6 months. However, by May 2024, it started climbing again and hit 8.3%. If we look at the broader picture over the past 5 years, there's been a significant shift in inflation trends in Russia, especially noticeable since the start of the Ukraine conflict. From February 2020 to February 2022, inflation climbed from a low of 2.3% to 9.2%. But following Russia's invasion of Ukraine on February the 24th, 2022, inflation soared dramatically. It reached 16.7% and peaked at 17.8% in April 2022. This surge can largely be attributed to the heavy sanctions imposed on Russia, which drove up prices of imports. However, the period from April 2022 to April 2023 presents a puzzling scenario. Despite ongoing sanctions and high import costs, inflation began to drop sharply. By February 2023, it had fallen to 11%, and then in March it plummeted further to 3.5%, eventually reaching 2.3% the following month. This dramatic increase in inflation is hard to explain, especially given the economic pressures from the sanctions, which would typically push inflation rates higher, not lower. Now let's have a look at the changes in interest rates. In February 2022, just before the invasion of Ukraine, the interest rates in Russia were already high at 9.5%. However, right after the invasion began, the Russian central bank dramatically raised the rates to 20% in what it termed as emergency measures. This move quickly impacted inflation, causing it to start dropping. Instead of waiting for inflation to return to its target of 4%, the central bank began lowering the interest rates. From April to October 2022, it cut rates 6 times, bringing them down to 7.5%, even lower than they were before the conflict began. However, from May 2023, inflation began to climb again despite the previous rapid decline. There's no clear explanation for this rebound in inflation. Between July 2023 and January 2024, the central bank responded by raising interest rates on 5 separate occasions, bringing them to the current level of 16%. To give some context to Russia's current interest rate of 16%, it's worth noting that among the G20, the group of the world's 20th largest economies, only Turkey and Argentina have higher rates at 50% and 40% respectively. Both countries are experiencing significant economic crises. The only other G20 nations with double-digit interest rates are Mexico and Brazil at 11% and 10.5%. Globally, Russia is ranked 18th for the highest interest rates. The 17 countries with higher rates include Venezuela, Turkey, Argentina, Ghana, Egypt, Nigeria, Malawi, and the Congo. All are undergoing serious economic difficulties. High interest rates like Russia's are generally indicative of major economic issues, as stable economies rarely need to maintain such elevated rates. This situation clearly highlights the economic challenges Russia faces compared to those seen in countries currently in economic distress. Over the last 12 months, food prices in Russia have also seen significant fluctuations. In May 2023, food prices were actually dropping by almost 1%. However, this trend reversed starting in June 2023, and food prices began a sharp increase, reaching a year-on-year growth of 8.2% by December. This level persisted until April 2024, but the latest data from May shows that food prices have climbed even higher to a 9.1% increase compared to last year. Given that the poorest members of society can spend between 70 to 90% of their income on food, a year-on-year rise above 9% is definitely concerning. This kind of increase can heavily strain household budgets, making it crucial to examine what has been happening with wages to fully understand the scope of the problem. Over the past year, there's been a notable rise in real wage growth in Russia. Real wages, which are adjusted for inflation, tells us if people are earning more compared to the previous year, accounting for price increases. Last year, real wage growth was recorded at 10.4%, meaning people were earning on average over 10% more than the year before despite inflation at the time. Recent figures indicate an even larger increase, with real wages growing by 12.9% over the past year. Considering the current inflation rates of 8.3%, this effectively means wages have grown by more than 20% in total. This substantial rise in wages comes amidst a challenging backdrop. The ongoing conflict has led to a significant workforce shortage in Russia, driven by a mass exodus of approximately 1.2 million people fleeing to avoid conscription along with losses due to the war itself. There's also a wage war, where competition for remaining employees has forced companies to raise salaries to attract and retain workers. While higher wages are beneficial for employees, they do not elevate the issue of raising food prices. This situation poses a challenge for Russia's economy. Increasing wages can further fuel inflation, creating a cycle where rising prices lead to higher wages. Over the past 5 years, the unemployment rate in Russia has shown significant fluctuations. In May 2019, before the COVID pandemic, the unemployment rate was stable at 4.5%. However, as the pandemic impacted the workforce, this rate climbed to a peak of 6.4% by August 2020. Subsequently, there was a steady and rapid decrease in unemployment, dropping to 4.1% by February 2022, closely aligning with pre-pandemic levels. Post the invasion of Ukraine in February 2022, the unemployment rate in Russia declined even further. The latest figures indicate that it's now at 2.6%. For comparison, in the US, the unemployment rate was 3.6% in June 2019, about 1% lower than Russia's at the time. The US rate spiked to 40.9% in April 2020 due to the pandemic, but has since corrected to around 4%, which is considered a normal level. Interestingly, the current 2.6% unemployment rate in Russia is unusually low and indicates potential economic issues. When unemployment drops too low, it suggests a shortage of workers available to fill jobs, which can limit productivity and growth. Russia is currently facing such a scenario. The workforce is too small to fill all job vacancies, potentially stalling company growth and negatively impacting the economy. This low unemployment rate, while seemingly positive, actually signals significant challenges for Russia's economic development. Apart from all these factors, the movement in producer prices in Russia over the past year also shows a significant change. Producer prices, also known as factory gate prices, are crucial indicators of what might happen with consumer prices later on. They tell us whether we might see more inflation or deflation in the coming months, depending on whether these prices rise or fall. Almost a year ago, in May 2023, factory gate prices in Russia were falling, showing a decrease of 3.6%. This trend reversed in June when the prices stabilized and remained flat. However, from then until October 2023, there was a sharp increase. Producer prices skyrocketed by 21.6% year-on-year by October. This increase edged up slightly to 21.9% in November and stayed above 19% for the next 4 months up to March 2024. In April 2024, the year-on-year increase was slightly lower at 18.4%. The most recent data from May 2024 shows a continued increase in factory gate prices at 16.2%, which is nearly double the current official inflation rate in Russia. This trend indicates that inflationary pressures might continue, affecting consumer prices down the line. The ongoing rise in factory gate prices in Russian currency at 16% suggests that consumer prices on the shelves are also likely to increase at a similar rate. The only scenario in which these increases might not reach 16% is if Russian companies decide to cut their prices to stay competitive. However, this is unlikely given the current economic climate characterized by extensive sanctions against Russia. These sanctions limit competition within the country and make any imported goods more expensive, reducing the incentive for domestic producers to lower their prices. This situation indicates the price pressures in Russia are expected to persist for at least the next 3 to 6 months, if not longer. Such pressures could lead to further inflation, potentially requiring another hike in interest rates. The trend observed in factory gate prices does show a slight downward movement, but it's predicted that these prices will continue to increase in double digits for the remainder of 2024. This spells trouble for inflation rates and the overall health of the Russian economy, signaling prolonged economic challenges with no quick fix on the horizon. When we look at the Russian economy, it's very important to see how the Russian ruble is doing against the US dollar. 5 years ago, you could exchange $1 for about 63 rubles, but over the next couple of years, the ruble's value dropped, and by October 2021, it took about 70 rubles to get $1. Just before Russia invaded Ukraine in February 2022, this had worsened to about 78 rubles per dollar. Right after the invasion, the ruble's value really tanked and it took 125 rubles to get $1. The Russian central bank then stepped in, buying up rubles to boost their value, and it actually worked for a bit, making the ruble stronger than it had been in 5 years at 50 rubles per dollar. But this was expensive to keep up, and by the summer of 2023, the ruble had slipped back down to 100 rubles per dollar. President Putin wasn't happy with this slide, so he told the central bank to fix it. They put some rules in place, like limiting how much foreign money Russian companies could hold, which helped some. As a result, the ruble got a bit stronger, and since November 2023, it's been trading at around 90 rubles per dollar. If we take a closer look at what's been happening with the ruble over the last year, you'll notice that there have been ups and downs in its value. Right now, the Russian central bank is working hard to keep the exchange rate stable at about 90 rubles to $1. They're doing this by buying rubles on the international market. However, the demand for rubles has dropped a lot compared to before Russia invaded Ukraine. Most Western countries aren't using rubles anymore because they're not trading with Russia. The major trading partners Russia has left are China and India, and both have refused to use rubles. China only wants to trade using Chinese yuan, so that trade doesn't help the ruble's value at all. At first, India wanted to trade using their currency, the rupee, but Russia didn't agree. They wanted to use rubles, but India said no. Now their trade happens